All right, let's dive into Palantir's latest and, maybe its most controversial earnings report. We're going to get straight to it.
So, get this. In fiscal year 2025, Palantir drops a bombshell, 240% growth in its official net income. I mean, a number that big seems almost made up, and you can bet it's attracted some serious scrutiny from Wall Street.
And really, that's led to the big question we're going to investigate today. Is this explosive growth actually genuine? Is it backed by real cash, a solid business, or is it all just a masterclass in financial smoke and mirrors? To get to the truth, we first have to understand why the market is so skeptical in the first place. So let's start by digging into the core arguments coming from prominent short sellers, folks like Michael Burry.
Okay, so accusation number one is that Palantir is essentially playing games with its accounting. The idea is that they're either pulling future revenue into today's numbers, or they're just getting really loose with credit terms to create profits that, well, only exist on paper.
And then there's the other classic critique, one that's been around for years. The bears have always argued that without these massive, non-cash stock payments to employees, the company wasn't ever really profitable, that it was all just an accounting gimmick.
So to find the real answers here, we can't just rely on opinions. We need to do a proper forensic investigation, and that means going straight to the source, Palantir's 3 core financial statements.
So, the crucial question we need to answer is this. Does the company's profitability still depend on this accounting adjustment, or has something fundamentally changed? Let's find out.
And wow, this chart right here illustrates a huge structural shift. Stock-based comp as a percentage of net profit has absolutely plummeted. It went from 148%, meaning it was bigger than their entire profit, all the way down to just 42%. This is clear-cut evidence that the profit isn't a gimmick anymore. It's real, even after you account for all that stock compensation. Okay, next up, let's turn to the balance sheet. Now, this is usually where companies might try to hide risks, things like risky acquisitions or dangerous levels of debt. But Palantir's balance sheet, it's like a fortress. It is incredibly clean. And that zero goodwill line, that's the key number. It proves that all this incredible growth is 100% organic. It wasn't just bought through a bunch of expensive acquisitions that could blow up down the road. No, they built this from the ground up.
All right, this brings us to the ultimate financial lie detector. This is where we directly challenge that very serious accusation about phantom revenues. The big question, does the cash actually show up?
Well, the data is just undeniable. Palantir reported $1.6 billion in net income. But look at its operating cash flow, over $2.1 billion. Let that sink in. For every single dollar of profit they reported on paper, even more in cold hard cash actually flowed into the company's bank account.
This ratio, cash flow coming in at 1.31 times net income, that's the ultimate proof. It's a financial smoking gun. It confirms the profits are absolutely real, the cash is flowing, and that whole bear case on accounting manipulation, it's fundamentally broken.
Okay, so we've established the financial reality. The numbers are totally solid. Now, let's take a look at the engine that's actually driving these incredible and very real results. You see, this isn't just a little bit of growth, it's a massive, seismic shift in their entire business model. Palantir has pivoted from selling custom services to the government to scaling a standardized AI software platform, AIP, for the entire commercial world.
And the success of this pivot is just staggering. U.S. commercial revenue, which is the heart of this new strategy, absolutely exploded by 109% in fiscal year 2025. This is that hyper-growth engine firing on all cylinders.
Now, to really understand how Palantir stacks up against the competition, we have to use the industry's own gold standard for elite performance, the Rule of 40. And when you put Palantir side by side with its peers, it's not even a fair fight. You've got these elite companies like Snowflake and ServiceNow hovering right around that 40% benchmark, which is great. But Palantir, they're clocking in at an astounding 127%.
What's so interesting here is how this really just visually captures this outperformance. I mean, this isn't just a little bit better. It completely breaks the traditional framework we use to evaluate top software companies. Palantir is a true outlier.
So, our investigation leads us to a really clear conclusion. The financials are flawless, and the business is firing on all cylinders. But, and this is a big but, this very perfection uncovers a completely new and very significant risk.
So let's just recap. We've systematically debunked the main accusations. The growth is real, the cash flow is strong, and the business model is just dominant. But all of this leads us to the final and probably the most critical part of our whole analysis.
You see, the market isn't blind. It has recognized this flawless execution, and it has priced Palantir for absolute continued perfection. The biggest risk here is no longer the business, it's the stock price itself.
Trading at roughly 129 times its forward earnings, that kind of valuation leaves zero, and I mean zero, margin for error. Any minor slip-up, any quarter that is simply great instead of absolutely historic, could be severely punished.
And that really leaves us with a crucial question for any investor looking at this today. The fundamentals are impeccable, no doubt, but the market has already priced in years and years of flawless execution. So the question becomes, is a perfect company actually worth a perfect price?